Hello there. While tensions are rising in the Middle East, gold is still relatively close to its all-time high around $2,100. Can we expect a sustainable breakout to new highs anytime soon? Well, let's have a look at the details. And welcome to myfinanceteacher.org, where our data-driven approach guides every step of our journey towards maximizing profits. And looking at gold, here are a couple of most likely scenarios. The recent decline down into the 11th of January might have given us a daily cycle low. These daily cycles usually last for around 1.5 months. Sometimes they could be as short as 29 days. So one possibility here is that we have seen a daily cycle low on the 11th of January, but it's very unlikely to be our intermediate cycle low. Hence, gold might actually continue slightly higher into the fourth daily cycle, perhaps test this recent high somewhere around 2100 before dropping down into the more recognizable intermediate cycle low. And that clearly will be your last buying opportunity before a sustainable break to new all-time highs. That is one of the scenarios. Perhaps I would give it, say, 40% chance. And another scenario, as these daily cycles usually last for longer than 29 days, perhaps we're going to see a continuation down into this daily cycle low, as well as the upcoming intermediate cycle low. There will be bounces on the way, of course. Intermediate cycle low, again, last chance to buy before breakout to new all-time highs. In this case, we'd remove this arrow to instead indicate our intermediate cycle low, perhaps sometime in the second half of February. But there is also a chance to see a relatively early intermediate cycle low, maybe giving us shorter than usual cycles. Usually these intermediate cycles last for around half a year, but out of the last 3 cycles, 2 were extremely long, lasting for well over 200 days. So a short cycle to bring the average duration back towards its typical half a year length is not out of the question either. Next, looking at the US dollar. US dollar is in a new intermediate cycle all the way since the 28th of December. This cycle, both the daily as well as the intermediate cycle, are only 19 days long. And as the daily cycles usually last for around a couple of months on the US dollar, there is still perhaps a pretty good chance, after a bit of a cool down from this 50-day moving average, that the dollar will continue to be relatively strong for perhaps another couple of weeks before declining for a short while into the daily cycle low, followed by another higher into that intermediate cycle top. And that's one of the reasons why our second scenario of a relatively weaker gold over the last several weeks is perhaps a little bit more likely. Next, moving on to market sentiment. Again, it's important to look at sentiment if you want to invest and trade based on the actual data rather than following your emotions. And of course, for a data-driven approach to trading and investing, make sure to join us at myfinanceteacher.org. Back to market sentiment. Even with a relatively mild intermediate cycle lows, as we saw in the second half of 2021, early 2022, for example, market sentiment, as shown by this gold optimism index, usually declines at least below this level of 50. And of course, a more discernible, more severe intermediate cycle low brings this optimism index all the way down below 40 and even closer to the level of 30. At the moment, it's at 62, so again, even if this short-term daily cycle continues a little higher in gold, perhaps even to test that 2100 again, there's likely going to be another buying opportunity with this optimism index, at least much closer to the level of 50, perhaps even lower than that. Next, a quick look at the COT reports. We're looking at the position of commercials versus the speculators. Commercials are red, speculators are green. Usually commercials are called the smart money, and usually their positions are rising into these intermediate cycle lows. Over the last several weeks though, since late October, the positions of commercials have only mostly been declining. And while this trend might continue, again, meaning that while gold might continue higher for another short while, that last buying opportunity into that short drop into the intermediate cycle low is still ahead of us before a sustainable break again to new all-time highs. Hence, both the COT reports as well as the market sentiment do suggest some patience waiting for that intermediate cycle decline in precious metals, while seasonality actually suggests that this continuation higher in precious metals might continue all the way into late February, extending this peak of our first slightly less likely scenario all the way again into late February, which again would be followed by this noticeable decline down into that intermediate cycle low. Hence, make sure to exercise patience. Don't click those buy and sell buttons with emotions of either FOMO or fear. Instead, let's employ data in our trades. For that, join us at myfinancesteacher.org. By the way, recently on the 9th of September, I suggested that the members get out of natural gas trades. Luckily, it turns out that the 9th of September was actually this very top where natural gas tested this 200-day moving average. We've been fortunate enough to catch this short bounce in natural gas, and as I mentioned in some of my public YouTube videos recently, we were expecting this bounce to be relatively short-lived. And so far, that's exactly what we see on natural gas. So for much more details, join us at myfinancesteacher.org by simply clicking this button, join now. Have a terrific Tuesday. Bye-bye.